Small risk does not mean small ambitions. You are not protecting yourself from one bad trade.
Everyone wants to talk about the trade they caught. Nobody wants to talk about the trade size that caught them.
Risk management reduces risk. It does not delete risk.
Todd, let me start with something uncomfortable. Why do so many traders spend months learning entries, indicators, patterns, setups, but still have no idea how much they should actually risk?
Because risk feels boring until it becomes the whole problem.
That is the line. Because everyone wants to talk about the trade they caught. Nobody wants to talk about the trade size that caught them.
Exactly. And that is usually where the damage starts. So a bad entry can cost you a trade. Bad risk can cost you the account.
So when people say, I need a better strategy, how often is the real answer actually no? You need a better relationship with risk.
More often than they want to admit. Most traders do not fail because they cannot read a chart. They fail because they cannot handle being wrong.
And that is what we are talking about today. This is Built for Traders, the podcast powered by Skyrus, where we talk about the real side of trading, the part behind the chart, the part behind the entry, the part that actually decides whether a trader survives long enough to improve. Today's episode is what 10 years of trading taught me about risk. And Todd, I want to get into the lessons traders usually learn after the market has already humbled them. Let's start with this. Why is risk management always treated like the boring chapter? People will watch 10 videos on entries. They will test indicators until their chart looks like an airplane cockpit. But risk? Suddenly everyone has somewhere to be.
Because risk management does not give people the dopamine hit. An entry feels exciting. A breakout feels exciting. A big candle feels exciting. Risk management is the adult in the room saying, okay, but what happens if this goes wrong? And nobody wants the adult in the room when they are emotionally attached to a trade.
So risk is basically the friend who ruins the toxic relationship by telling the truth.
Exactly. Risk is the friend saying, you know this is not good for you, right?
But it is also the friend you should have listened to 3 losses ago.
That is the painful part. Most people respect risk after they have already paid for the lesson.
And that is why this episode matters, because risk is not there to scare people away from trading. It is there to keep them from treating uncertainty like a personality test.
Exactly. A trade is not a test of your confidence, it is a test of your process, and risk management is what keeps that process from turning into chaos.
Okay, let's attack the biggest obsession in trading. Entries. Why do traders give entries so much power?
Because entries are visible. You can screenshot them, you can circle them, you can post them. Risk is invisible until something goes wrong.
That is so true. Nobody posts, look at this beautiful position size.
Exactly. There is no viral post that says, I reduced my exposure and protected my downside.
Even though that is the mature trade.
It is, but it does not look exciting. The problem is, traders think the entry is the trade. It is not. The trade is the entry, the stop, the size, the target, the timing, the market condition, and your ability to follow the plan when it stops feeling fun.
So basically, the entry is one scene. The trade is the whole movie.
Exactly. And some traders are judging the movie from the trailer.
That is painfully accurate.
A good entry with terrible risk is still a terrible trade. If the position size is too large, the stop is random, and the trader has no plan for being wrong, then the entry is not saving anything.
So when someone says this setup is strong, the next question should be, strong enough for what size?
Yes, and also, what proves the idea wrong? Because if you do not know where the idea is wrong, you do not have risk management. You have hope management.
Todd, I want to say something, and you tell me if it is dramatic or true. Your lot size exposes you.
It is dramatic, but it is true.
I knew it.
Because position size often reveals the trader's emotional state. A trader who is patient sizes differently from a trader who is desperate. A trader who accepts losses sizes differently from a trader who needs to be right. A trader who has a plan sizes differently from a trader who is trying to make back yesterday.
So lot size is basically a mood ring with financial consequences.
That is one way to put it.
That is terrifying.
It should be a little terrifying because a lot of traders do not choose size based on risk. They choose size based on emotion. They feel confident, so they size up. They feel behind, so they size up. They feel angry, so they size up. They feel like the market owes them, so they size up. And That is where risk stops being a calculation and becomes a reaction.
So, what is the better way?
The better way is boring, which is why it works. First, decide how much of your account you are willing to risk on the trade. Then define where the trade idea is invalid. Then calculate the position size based on that distance.
So, the order matters. It is not, I like this setup, let me go big. It is, if this setup fails, what is the controlled loss?
Exactly. The position size comes from the risk plan, not from the vibe.
Trading by vibe is a tragedy in 3 candles.
And usually one oversized lot.
Let's talk about the famous 1% rule, because everyone hears it, everyone quotes it, and then somehow everyone behaves like they have never met it before.
That is the most accurate description of trading education.
What is the actual point of risking 1% or 2%? Because some people hear that and think, that is too small. I am trying to grow.
That is the mistake. Small risk does not mean small ambitions. You are not protecting yourself from one bad trade. You are protecting yourself from the 5 bad decisions that happen after one bad trade.
That is so important. The real danger is not always the first loss. It is the emotional sequel.
Exactly. A trader loses once and thinks, fine. Then they lose again and think, okay, now I need it back. Then suddenly the third trade is not analysis. It is revenge wearing a candlestick costume.
Revenge wearing a candlestick costume is crazy.
But accurate. The 1% rule exists because one trade should not decide your month.
So it is not about being timid. It is about not giving one trade the keys to the whole account.
Exactly. If one trade can emotionally or financially destroy you, the trade is too big, even if the setup is beautiful. Especially if the setup is beautiful, because that is when traders get reckless.
The prettier the setup, the more suspicious we should be of our confidence.
Yes, confidence is useful, but unmanaged confidence is expensive.
Let's go into the emotional side. You said earlier, most traders fail because they cannot handle being wrong. Why is being wrong so hard in trading?
Because in trading, being wrong has a number attached to it. In normal life, if you are wrong, maybe you feel embarrassed. In trading, if you are wrong, your account updates immediately. That is brutal feedback.
The market is basically a scoreboard with no empathy.
Exactly. And that is why traders personalize losses. They do not say, this trade idea failed. They say, I failed. As if every loss becomes an identity crisis. You cannot make rational decisions.
So the goal is to separate the trade outcome from the trader's ego.
Yes. A loss can mean many things. It can mean the setup failed. It can mean the timing was off. It can mean the market condition changed. It can mean the trade was valid but did not work. But traders often jump straight to, I am bad at this, or worse, I need to prove I am right. That is where revenge trading starts.
So risk management is also ego management.
Absolutely. A stop loss is not just a number. It is a pre-written agreement with your calmer self.
That line is dangerous.
It is true. Before the trade, your calm self says, if price reaches this level, the idea is invalid. During the trade, your emotional self says, maybe give it more room. Risk management is deciding which version of you gets authority.
And we should probably not give authority to the version of us sweating over a 5-minute candle.
Correct. That version needs water and distance from the mouse.
Let's stay on stop losses. Why do traders treat getting stopped out like betrayal?
Because they secretly wanted the stop to be decorative.
Decorative risk management is horrifying.
But common. A trader places a stop because they know they should. Then price gets close to it and suddenly they start negotiating. Maybe I placed it too tight. Maybe it needs more room. Maybe the market is hunting stops. Maybe I should wait. Sometimes there are legitimate adjustments if the plan allows it, but most of the time, moving a stop in panic is not analysis, it is avoidance.
So the stop is not the enemy. It is the boundary.
Exactly. Stop loss says, this is where the trade idea is no longer valid enough for me to keep risking capital. That is healthy.
That is important because even risk tools are not magic.
Exactly. Risk management reduces risk. It does not delete risk, and that distinction matters.
So if someone is using a stop loss but sizing too big, they are still in danger.
Yes, a stop loss with oversized position size can still create an oversized loss. The stop is only one part of the plan. The size is what decides how painful that stop becomes.
So we are back to size again.
We are always back to size. Size is where risk becomes real.
I want to talk about risk reward because traders love making charts look very professional with boxes. One red box, one green box. Suddenly, everyone is a fund manager.
The rectangles give people confidence.
Too much confidence. How should traders actually think about risk reward?
Risk reward is useful, but it has to be realistic. A1, 3 ratio does not automatically make a trade good. If the target is random and the stop is random, the ratio is just decoration.
So dragging the green box higher does not improve the trade?
No, it improves the screenshot.
That is disgusting but accurate.
A valid target should make sense based on structure, volatility, liquidity, or whatever framework the trader uses. A valid stop should make sense based on invalidation. If both are just placed to make the trade look attractive, the trader is not managing risk. They are designing a fantasy.
Risk reward cosplay.
Exactly. And that is dangerous because it creates false confidence. A trader says, I only need to win a few times because my reward is so big. But if the target is unrealistic, the math is fake.
So the real question is not just what is the ratio? It is the ratio believable?
Yes. Can I execute this plan repeatedly without changing it every time I feel uncomfortable? Because the risk reward on paper and risk reward in execution are not always the same thing.
Let's talk about daily loss limits because this is one of those rules people agree with in theory and then disrespect in real time.
Yes, because daily loss limits feel annoying until they save you.
Like seatbelts.
Exactly. Nobody says, wow, this seatbelt is really limiting my driving freedom.
Some traders would.
Actually, yes. Traders absolutely would, but the purpose of a daily loss limit is not just to protect money, it protects decision quality. After a certain number of losses, many traders are not analyzing anymore, they are reacting.
And there is a huge difference between trading and reacting.
Huge. Trading says, this setup meets my criteria. Reacting says, I need to fix how I feel. That is when the danger starts.
That line is painfully accurate. I need to fix how I feel is probably behind half the bad trades on earth.
Exactly. A daily loss limit interrupts that spiral. It says you may not be in the right state to make the next decision. And that is not weakness. That is professionalism.
So stopping is not giving up. It is protecting tomorrow's version of you.
Yes. Some days the win is not making the damage worse. That does not sound glamorous, but it is real.
And weirdly mature.
Trading makes you mature or expensive, sometimes both.
Okay, I want to challenge something. People say risk management is boring, but when you describe it properly, it actually sounds like freedom.
It is freedom. Because if your risk is controlled, you do not have to panic over every candle. You already know the cost of being wrong. That gives you mental space.
So the irony is, risk management makes trading less emotional, not more restricted.
Exactly. Traders think rules trap them, but rules actually protect them from their worst moments. Without rules, every decision becomes emotional. Should I hold? Should I exit? Should I double down? Should I move the stop? Should I take another trade? That is exhausting.
So a risk plan is not there to make you robotic. It is there to stop you from negotiating with chaos.
Perfect. And after enough years, you realize trading is not about controlling the market. You will never control the market. You control your exposure, you control your size, you control your plan. You control whether one loss becomes one loss or becomes a whole personality episode.
A whole personality episode is exactly what we are trying to avoid.
Yes, because the market can be irrational longer than your account can survive bad sizing.
That is the real lesson. You cannot outconfidence bad risk.
Never. Confidence is not capital protection. A plan is.
Todd, let's end this with the clean version. If someone is watching this and they remember nothing else, what should they take from this episode?
First, your entry is not the trade. The trade is the full plan. Second, position size matters more than confidence. If the size is wrong, even a decent setup can become a problem. Third, a stop loss is not personal. It is the point where the idea no longer deserves your capital. Fourth, daily loss limits are not a weakness. They protect decision quality. And fifth, risk management is not about avoiding losses. It is about making sure losses do not remove you from the game.
That is the episode. Risk is not the boring part. Risk is the part that decides whether you get to keep learning. This has been Built for Traders, powered by Skyrus. If this episode made you rethink how you size your trades, share it with another trader who needs to hear it before the market teaches it the expensive way. Next episode, we are talking about what price action actually looks like without indicators. Todd, any final words?
Yes, if your chart has 12 indicators, but your risk plan has 0 rules, the chart is not the problem.
Painful, accurate. See you in the next one.